quiet hemorrhage occurs inside millions of brokerage accounts every trading day without triggering a single panic alarm. Investors track daily market fluctuations with intense scrutiny, yet they remain blind to the continuous daily deduction embedded within their fund holdings. That small percentage point listed on a fund prospectus seems harmless at first glance. However, when subtracted directly from gross portfolio returns before compounding occurs, it acts as a silent drain on long-term wealth accumulation. The expense ratio represents the annual percentage fee charged by an asset management company to cover administrative, management, and operational costs. Every morning before net asset value is published, the fund manager slices off a fractional fraction of the fund's total capital. This fee is automatically deducted from total assets regardless of whether the market goes up or down. Even in a declining market, the fund management entity collects its predetermined slice, transferring systematic risk entirely onto the retail investor. The key mathematical error made by most investors is treating fee percentages as simple linear subtractions from final balances. A 1.0% expense ratio does not mean you sacrifice merely 1.0% of your eventual wealth over a lifetime of investing. Because that deducted money is permanently pulled from the principal, it forfeits all future compound growth it would have generated over subsequent decades. The true opportunity cost is not the cash paid in fees today, but the massive, accumulated fortune those dollars will never build. For decades, active fund managers argued that higher management fees were justified by superior stock selection and market timing capabilities. Historical performance data tells a starkly different story. Over 20-year horizons, the vast majority of actively managed equity funds fail to beat their benchmark market indexes after accounting for fees. Investors pay a heavy premium for active stock selection, only to receive net returns that lag behind passive index funds that charge virtually nothing to operate. Human psychology leads investors to believe that higher price tags indicate higher quality products, a rule that holds true in consumer retail but fails completely in financial markets. In asset management, you retain precisely what you do not pay for. Paying an active manager 2.0% annually does not buy superior execution or privileged insight. It merely creates a mathematical hurdle that the portfolio must overcome every single year just to break even against low-cost competitors. The mechanics of fee drag operate continuously behind the scenes through daily net asset value adjustments. If an index yields 10.0% in a given year, a fund with a 1.0% expense ratio returns 9.0% to the investor. That single percentage point difference appears modest in year one. Yet, when projected over a 30-year investment horizon, that single percentage point fee drag strips away over 25% of the total potential wealth that the initial capital could have produced. Consider a baseline scenario where an investor deposits $10,000 into an index fund, returning an average 8.0% annually. Over 40 years, without any ongoing fees, that initial lump sum grows to roughly $217,000. Introduce a 1.0% annual expense ratio, and the final accumulation drops to approximately $149,000. The investor surrenders nearly $70,000, or roughly one-third of their lifetime net wealth, directly to asset management overhead. Wall Street structures asset management fees to feel invisible to the retail participant. Because the fee drag is extracted silently from asset balances rather than sent as an explicit monthly invoice, investors rarely feel the immediate pain of payment. Financial institutions capitalize on this psychological friction gap, collecting billions in predictable recurring revenue while investors focus solely on gross market movements. This billing design obscures the massive wealth transfer taking place from portfolio owners to fund managers. The emergence of low-cost index funds in the late 20th century fundamentally disrupted this traditional fee extraction model. Pioneer funds proved that tracking a broad market index at an expense ratio of 0.05% could consistently outperform 90% of high-fee active funds over extended periods. This historical shift exposed fee drag as the single greatest predictor of future fund underperformance, changing the foundational principles of modern portfolio construction. When markets undergo severe downturns, high expense ratios accelerate portfolio destruction. During market crashes, active management fees continue to be deducted from shrinking total balances. A portfolio suffering a 20% decline while carrying a 1.0% expense ratio experiences immediate structural damage that requires an even higher recovery percentage just to return to break even. Fees act as an artificial weight during bear markets, deepening losses when capital preservation is most critical. For institutional pensions and individual retirement accounts alike, fee drag dictates the timeline of financial independence. A worker saving diligently over 30 years may discover that fee drag forces them to extend their career by several additional years simply to recoup wealth lost to management costs. The mathematical reality of negative compounding transforms what looks like a minor fee detail on paper into years of additional labor in the physical world. At a macro scale, the collective impact of expense ratios redirects trillions of dollars across the global economy. Capital that could remain within productive compound vehicles, funding enterprise growth and individual retirement security, is systematically diverted into administrative overhead and institutional profit margins. The shift toward low-cost index products has reclaimed hundreds of billions of dollars for end investors, radically shifting capital retention across entire markets. Beyond nominal expense ratios, portfolios often harbor additional hidden costs that compound the negative drag. Turnover costs, bid-ask spreads, and trading commissions inside active funds create an unspoken layer of extra expenses not reflected in the published headline fee. When an active fund turns over its portfolio completely each year, trading friction further reduces net returns, compounding the disadvantage against low-cost passive structures. A common myth persists that skilled managers can consistently deliver alpha or risk-adjusted outperformance to offset higher expense ratios. While short-term outperformance occurs periodically due to market variance, longitudinal studies confirm that persistent alpha is statistically rare over multi-decade spans. Market efficiency ensures that excess returns generated by active bets are systematically consumed by the fees required to execute those strategies. The math of compounding contains a profound asymmetry that works against fee-heavy portfolios. While positive compound returns build wealth exponentially over time, continuous fee deductions erode the compounding base exponentially as well. Every dollar taken out in year 5 is a dollar that cannot double in year 15, fourfold in year 25, or eightfold in year 35. The compounding loss grows larger with every year that passes. The evolution of institutional investing has increasingly forced asset owners to prioritize low expense ratios above speculative outperformance promises. Sovereign wealth funds and massive public pension systems now negotiate basis point fees down to absolute minimal fractions. These massive institutional investors understand that control over costs is the only guaranteed variable in an environment defined by market uncertainty and persistent volatility. Controlling expense ratios is one of the few variables an individual investor can completely command. Market cycles, geopolitical shocks, and interest rate fluctuations remain entirely outside personal influence. By choosing low-cost index vehicles, an investor eliminates unnecessary structural drag and locks in their fair share of total market returns. Discipline in managing expenses serves as the most reliable cornerstone for long-term wealth preservation. When multi-generational wealth preservation is the objective, the compounding impact of expense ratios becomes staggering. Over a 50 or 60-year horizon spanning multiple family generations, high expense ratios can consume over half of the potential net estate value. Eliminating excess fund fees ensures that accumulated capital stays within the family compound structure rather than transferring quietly into corporate fee structures. The relentless math of negative compounding makes expense ratios the defining factor dividing successful investment strategies from underperforming portfolios. Asset management is ultimately a game of net returns. Every basis point saved in annual management fees is a basis point added directly to compound growth, compounding silently in favor of the investor rather than working continuously against them. Ultimately, understanding fee drag restores strategic agency to every market participant. The mathematical demonstration is clear. Minimizing expense ratios is not merely a passive savings measure, but an aggressive, mathematically proven strategy for maximizing long-term capital accumulation. By protecting principal from unnecessary fee extraction, investors harness the full, unencumbered power of compound growth over time.